Welcome to the Nichols Tax Update podcast for May 3rd, 2021, issue number 2118. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I always acknowledge the value in the preparation of this program of my subscription to Tax Notes Today, published every day by tax analysts, the preeminent source of information for tax professionals, and I recommend it to you for your tax library. In any event, we got a lot to do today. What's in this edition? Some question marks, some exclamation points. The IRS amends prior guidance on credits. I think we talked about this a little bit last week. I want to touch on it again so everyone understands what the deal is or what the IRS says it's going to be. The tax court determines the fair market rent for a pharmacy in Plentywood Pharmacy out in Montana. And it's just proof that you are never so far away that the IRS cannot reach you and engage in a full-blown study of how you conduct your business. The Plentywood, Montana has 1,700 residents, and the IRS got fully engaged with an appraiser and all that went with it. Anyway, the tax court explains the conditions that distinguish deductible legal fees from those required to be capitalized in the drug business, where one company has a patent, the patent is running out, another company wants to make a generic version, they have to send a notice. We'll talk about how that works, and of course a lot of legal fees are involved. Then the IRS is asked to trigger inventory rules, which they have to do. The Secretary of the Treasury must issue and must publish in the Federal Register a notice that the provisions in Section 473 for revaluing LIFO or revaluing inventory where your inventory has been liquidated due to a disaster of some kind. And certainly the pandemic has been a disaster. So we need the Secretary of the Treasury to publish the notice so we can trigger the provisions in Section 473 so that automobile dealers in particular don't have to recognize a lot of phantom income solely because they liquidated their LIFO inventories. Then the IRS offers advice to gig workers and taxpayers who received unemployment benefits. The essence of this advice is trust us. Now this is the Internal Revenue Service, right? Stay tuned. Finally, this week, the IRS uses the bank deposit method. When will taxpayers learn to prove taxable income? Over $6 million was deposited in 9 accounts over a period of 2 years. So let's get to the nitty-gritty. Here in Revenue Procedure 2021-23, on April 25th, the IRS corrects previous guidance in Revenue Procedure 2020-36 and Revenue Procedure 2020-45. The 36 Rev Proc gave the applicable percentages used to calculate a taxpayer's premium tax credit and the required contribution percentage used to determine whether an individual is eligible for employer-sponsored minimum essential coverage under Obamacare or whatever care it is now for 2021. Revenue Procedure 2020-45 gave you the inflation-adjusted items for 2021 for the child tax credit and the earned income credit. Both of those revenue procedures, the topic they addressed, was changed by the American Rescue Plan Act of 2021. And so you cannot follow Rev Proc 2020-36. You cannot follow Rev Proc 2020-45. You must follow Rev Proc 2021-23, and you probably should revisit any early filed returns where you had issues that led you to look to these two revenue procedures, which have been superseded or corrected, I suppose, is probably the right term. And that, of course, is a life preserver ring. The American Rescue plan. All right, well, I did the best I could with the symbol. The tax court has determined the fair market rent for a pharmacy, Plentywood Drug Incorporated, TC Memo 2021-45. 4 taxpayers, husband, wife, and a child and spouse, so 4 family members, owned a corporation that had operated a pharmacy in Plentywood, Montana, from the beginning of time, a long time. And they owned the building that they operated the pharmacy in. It was really more a general store than it was a pharmacy. They had the main floor, and then they had the basement. They sold everything from diapers to pharmaceuticals to things that you might need. It was really a general store. So somehow the IRS decided to take a look at the rent the family charged for the use of its building. So the family owns the building, 4 family members, and the same 4 family members own the corporation that operates the pharmacy and the general store. They established their rent at $192,000 a year. The IRS comes calling. Actually, didn't come calling. They sent in an undercover operative who did not identify himself as an IRS agent as he snuck around Plentywood, Montana, trying to determine what were reasonable rents. Now, the IRS thought $192,000 a year was too much. They hired an expert, and the expert said that $59,319 a year was just the right amount. And that difference was so big, of course, that it was constructive. It was going to be a constructive dividend anyway. It's a lot of money, and the basis for Section 6662 penalties for negligence and underpayment of your tax. Tax court Judge Mark Holmes is no dummy. He's been around for a long time. He was critical of the IRS expert's comparables because the 2 of the comparables the IRS expert used were rents for government-subsidized housing, not commercial buildings, but apartment houses. And so the judge hears everybody's experts. Taxpayers had their own experts. And the taxpayers' expert said, look, Your Honor, there's a post office in Plentywood, and the federal government pays rent on the post office at $15 a square foot. It's the only comparable building in Plentywood. It's the only comparable business building. So let's use the post office rental rate. Judge Holmes thought that was a great idea. And he goes through the calculations and comes up with $171,187.50. That 50 cents is important, I guess, to be a fair amount based in large part on the rent that was paid for the local post office. And by the way, no penalties because the IRS agent failed to get supervisory approval to assess any penalties in the first place. Really? You know, this case, and I wrote this, I'm going to read it. This case should stand as a warning to anyone who thinks their business affairs are too small for the IRS to bother with, and who thinks that where you're setting the rent on the property that you own, that you can ignore fair market principles. You can't. Now, Plentywood was right to resist, but we should all take note here that the IRS was well within its operating rules to take on some poor general store in the outback of Montana. It could be you next. Speaking of pharmacies, by the way, here's a multi-million-dollar deduction. Mylan. Mylan makes generic drugs. They wait until the patents are about to expire, and then they serve a notice to the Food and Drug Administration asking for approval to manufacture generic drugs. That starts a patent defense, as you can imagine, and is capitalized. So the expenses Mylan incurs to develop and write and send that notice letter must be capitalized. But the legal expenses incurred in defending against the patent infringement suit, which the patent holder is immediately going to file, are deductible as ordinary and necessary business expenses because they were not part of the FDA approval process. So that initial letter, that notice letter, is part of the FDA approval process, and it must be capitalized. But the subsequent legal fees that are paid have nothing to do with the FDA approval process. They have to do with defending my position in litigation. And the judge observed here that the patent holder is permitted to deduct costs of holding on to exclusive use of the patent. And so this is Tax Court Judge Patrick Erda. He's fairly new. He doesn't have the experience that Judge Holmes has, but he's on the right track. He's got a good head. Patrick Erda says, listen, if I'm going to allow the patent holder to deduct the expenses to defend what they've got, I'm going to allow you that want to do away with the patent, I'm going to allow you to deduct your expenses as expenses incurred in connection with producing income. You can produce income if you can get access to the patented drug and make a generic product, you can make money. And so you can deduct the expenses that are involved in the litigation to gain access to the patent. You cannot deduct the expenses of serving notice in the beginning that you're going to start this process. Makes sense to me. Auto dealers facing LIFO recapture was the headline. Tax Notes today, April 30th, article by Nathan Richmond. The AICPA has joined the auto dealers' request for inventory relief. The NADA wrote a letter back in November of 2020. The Treasury Secretary can and should exercise his discretion to provide Section 473 relief to taxpayers with potential surprise income arising out of inventory replacement difficulties that are induced by foreign trade disruption. And it is the foreign trade disruption, which is the product of the pandemic. They can't get people to work in the factory to make the parts to make the cars. It will be easy to allow auto dealers 3 years to replace their inventories that are depleted by parts shortages, which result in a depletion of the automobile inventory. And here's my illustration of the automobile dealer's empty showroom with only one car on the lot. The sign on the door says open, but for what? If you don't have any inventory to sell, and if you have liquidated your LIFO inventory, there could be a lot of phantom income in that. And all the AICPA is asking for, all the NADA is asking for, is 3 years to replace that inventory without taking a hit on the benefit, without losing the benefit of their LIFO inventory. Then information for gig workers, unemployment comp recipients. The information for gig workers is a single paragraph. Gig workers are reminded to keep records of your business transactions, and in that same information release, the IRS goes on at length to remind those who received unemployment compensation in 2020 that the first $10,200 is not taxable. And if you've already filed a return, don't worry, trust the IRS to refigure your return, calculate a refund if you have a refund coming, and recalculate any credits that you have coming, and give you the tax benefit of, and give you the benefit of everything that you would have claimed if you'd completed the return yourself. It sounds like we're getting dangerously close to the IRS completing my return for me, and all I have to do is press a button. They already know everything that I would put in the return. Cash deposited in the bank is income. Joseph Hagnazareda and his wife just put money, they got money, they just put it in one of their 9 bank accounts. $4,854,849 of unreported income for 1 year, almost $2 million for the next year. They reported $245,000 about in each year. Supposedly, I guess they thought that would be safe. This is nuts. No one should do this, but apparently Mr. and Mrs. Agnareda did. So the IRS sends in somebody to do a bank deposit analysis. It's the oldest IRS audit technique in the book. The IRS determined that over $6.5 million was deposited into these 9 bank accounts, and it should be treated as non-taxable deposits. The case is made here for records, contemporaneous records. Where did the money come from? If it was not yours and you put it in your bank account, what happened to it eventually? You need to have the records, and you need to have your story straight if you're going to defend against an IRS bank deposit analysis. Well, children, that's it for another week. The pandemic is slowing down. We're going to get back to work soon. And remember, still, stay safe. We need each other to get through all of this.